Now we can start to see the amendments in FETA law. This is applicable for May 2026 exams and onwards for both IBS exam and FETA exams. You can refer to this. So the amendments are there in SEBI regulations and then economic laws, Foreign Exchange Management Act, Foreign Contribution Regulation Act, and then the Insolvency Bankruptcy Code. So in these only we are having amendments. The first amendment we can see from LODR regulations. The first point is in maximum number of directorships. This is an important point. It may be asked in FETA exams and IBS exams also. So focus here. So when you see Companies Act, what is the limit? A person can be a director in maximum 20 companies in the same time. But in SEBI LODR regulations, which is for the listed entities, a person can be a director in maximum 7 listed entities. Then a person can be an independent director in maximum 7 listed entities. Then if the person is already a MD or WTD in a listed entity, then he can be an independent director in maximum 3 listed entities. So this is the limit. There is no change in this limit. This was there previous also and now also the same limit. But now the change has come in the place of listed entity. What is the meaning of listed entity? Listed entity means an entity whose equity shares are listed and high value debt that is also listed. So if one company is there, for that equity shares are listed, that will also be considered as a listed entity. Another company is there, that company has listed debt, it is a high value debt listed entity, then that company will also be considered under listed entity. So either equity shares or high value debt listed entity, these two will come under the listed entities. Alternate directorship, now it is included in the count. When you are doing an alternate directorship, that will also be counted in this limit. Next, exclusion, ex officio directorship. When you are a director because of your some other position. For example, in a PSU, you are in some official position, or public-private partnership entity, you are in an official position. Because of that, you are a director. Then that position will not be counted in the above limit. The next point is complaints officer. Complaints officer should be a senior employee. The complaints officer should be whole-time employment. So the complaints officer should be a whole-time employee of the company. And then he should be one level below the board of directors. The board of directors are there, and then one level below. Here the company secretary, who is the complaints officer, he should be there here, complaints officer. The interpretation is the complaints officer should directly report to the board of directors. In such a manner, the hierarchy should be there. Next, designation. He should be designated as key managerial personnel. So complaints officer should be coming under key managerial personnel. Then he cannot be an external consultant. You cannot take an external consultant and say that he is the complaints officer. He should be in full-time employment under the company. Next, during insolvency, when a company is undergoing insolvency and it is not having a complaints officer, after the resolution plan is approved, then what will happen? The resolution plan is approved, but the complaints officer is not there. Within 3 months of the approval of resolution plan, you have to appoint a complaints officer. Then during the 3 months, within 3 months you have to appoint. During that, in between 3 months, one full-time key managerial personnel should manage the day-to-day operations until the appointment. That work in between the 3 months, it should be done by the full-time key managerial personnel. After that, we will appoint within that we should appoint the complaints officer, and he will take on that work. Next, secretarial audit, regulation 24A. When you are a listed entity and your material unlisted subsidiaries incorporated in India. For every listed entity, this is applicable, and the material unlisted subsidiaries incorporated in India of such a listed entity will also undergo secretarial audit. Secretarial audit is mandatory for all these people. Now, the requirement, the secretarial auditor, he should be a peer-reviewed company secretary. It may be an individual company secretary or a firm of company secretary, but it should be peer-reviewed. Reporting, the report of the secretarial auditor, the final report which is given by the secretarial auditor, it should be annexed to the annual report of the listed entity. Then the term of individual. If an individual company secretary is appointed, the maximum term is one term of 5 consecutive years. Then if you are appointing a company secretary firm, then maximum 2 terms of 5 consecutive years. One term, 5 years. So 2 term means total 10 years. You can appoint a single firm. Approval. You should get the shareholder approval in the annual general meeting. Next, quarterly and periodic compliances. They have changed the timelines. Within this much time, you have to file the quarterly report. Within this much time, you have to file the corporate governance report. The timelines they have changed. So investor complaints. For all this, they have changed the timelines to timeline specified by SEBI. Earlier, there had been 21 days timeline. But now they have amended it and given that timeline specified by SEBI. Whatever the SEBI is giving the notification, that timeline will be applicable. So for investor complaint, within the timeline as specified by SEBI, you should show the pending complaint, received complaint, disposed complaint, or unresolved complaint. So they may ask, during the year, the company had pending complaint 19, and then the received complaint, they received 1, and then they dispose the complaint of 2, and then unresolved complaint, how much? Like that they may ask you. So you have to add and do this and find out the answer. There will be a very easy question only, but this type of question also, it may come. So that's why you should know, for investor complaint, within the timeline specified by SEBI, these pending, received, disposed, and unresolved complaint, this should be shown in that report. Next, corporate governance report. This also should be filed within the timeline specified by the SEBI. Currently, the timeline is 30 days, and annual report should be submitted within 6 months of financial year end. The annual report has to submit within 6 months of financial year ending. Next, financial results quarterly and year to date. The interim financial information that you have to submit within 45 days from the end of the quarter except the last quarter. Next, when the company is undergoing IBC and the resolution plan is getting approved, so the resolution plan, when it is getting approved, you have to see two things: whether it is approved in the first 3 quarters or it is approved in the last quarter. That you have to see. If it is approved in the first 3 quarters, then you have to submit the results within 90 days from the end of that quarter. The financial results, the interim financial results, you have to submit within 90 days from the end of the quarter for the first 3 quarters. Then IBC cases are going. IBC, insolvency resolution process, is going on. Resolution plan is approved. Then you have to submit the results within 90 days from the end of the quarter for the first 3 quarters. Then, when the resolution plan is approved in the last quarter, the annual complaints of 60 days will apply. Within 60 days, you have to submit. Normally, 90 days you will get when the resolution plan is approved in the first 3 quarters. When the resolution plan is approved in the last quarter, then 60 days timeline will apply. Next, prior intimation to the recognized stock exchange. When you are doing dividend, right issue, bonus issue, conversion of debenture, merger, demerger, you have to intimate to the recognized stock exchange. So, at least 3 working days before the record date, you have to inform it to the recognized stock exchange. The 3 working days, you should exclude the date of intimation and the record date. Record date here you are having, and then the date of intimation here you are having. In the state only you are intimating the stock exchange. This is the record date. In between also 3 days should be there. So that is the thing. Next thing is corporate governance with reference to the subsidiaries. Material subsidiary definition. Now the definition is turnover or net worth, which is more than 20% of the consolidated total of the previous year. Previous year turnover, net worth. The turnover or net worth of the subsidiary is more than 20% of the consolidated total in the previous year, turnover or net worth. So 20% is the limit, more than 20%. Next, when you are disposing of more than 20% assets of the material subsidiary, the material subsidiary has 100 crore assets, you are selling 30 crore assets. So more than 20% of the assets you are selling. Then what you have to do, you have to get the approval from the shareholders by getting a special resolution. Special resolution you should pass, only then you can sell that much assets. New exemption. You are having some 2 points where this special resolution is not required. When it is a disposal between 2 wholly owned subsidiaries of the same listed entity, the listed entity is there, 2 wholly owned subsidiaries is there. Subsidiary 1, subsidiary 2. In both the subsidiaries, 100% ownership is there with the listed entity only. So, this subsidiary's assets, 30% they are selling to subsidiary 2. So, in this case, no need to obtain the special resolution. Next, disposal under a court or tribunal scheme or IBC resolution plan. When you are disposing the assets under a scheme of court or tribunal or resolution plan approved, then in that case, no need to get the special resolution. But you need to give the disclosure to the recognized stock exchange within 1 day. So, recognized stock exchange disclosure should be there, but special resolution not needed. Next point, committee membership limits. Chairmanship committee, the chairmanship of audit committee, membership of multiple committees. In that, there are limits. So for chairmanship, we are having a limit for how many committees a person can be the chairman, and then membership in audit and stakeholder relationship committee. For audit committee and then stakeholder relationship committee alone, we will count the maximum membership, only this much you can be. So all the public limited companies, one person can be a member in audit committees and stakeholder relationship committees, only total this much. So total 10 membership only should be there. If that is the limit, then the total committees, the total membership of all the committees, audit committees and then stakeholder relationship committees, only these committees, total should be up to 10 only. So that is the limit here. All public limited companies, listed or unlisted, and high value debt listed entities. So if you are a member in audit committee or stakeholder relationship committee in a listed entity or public listed company or high value debt listed entity, then that you have to count it. Then excluded from count, private limited companies, foreign companies and Section 8 companies. So when you are a member or chairman of the audit committee or stakeholder relationship committee, that will not be counted in the limit. In the SEBI LODR regulation, we are having the committee membership limit. In that limit, this will be counted, this will not be counted. Earlier also in the directorship limit, we had included the high value debt listed entity because of the amendment. So here also they are including the corresponding thing. Here also high value debt listed entity they are including. So the next thing is Regulation 21, Risk Management Committee. The maximum gap between 2 consecutive meetings has been increased to 210 days. Previously 180 days. Risk Management Committee, for multiple committees, we are having the time limit for meeting also. At least in one financial year, you have to meet 3 times or 4 times. Then the maximum gap should be 180 days only. Like that, we are having some limit. For Risk Management Committee, earlier 180 days limit was there. Maximum gap between 2 committees, 2 meetings. That has been increased to 210 days. So earlier when you are having one meeting, within next 180 days, you should keep another meeting. But now that limit has increased to 210 days. Next, that's all about the SEBI LODR regulations amendments. Now we can see the SEBI ICDR regulations. In this, what all the amendment we are having? The applicability. ICDR regulations will be applicable when these things are happening. When an unlisted issuer is doing an initial public offer, when a listed issuer is doing a further public offer like this, in various cases, these regulations you should follow. Earlier, when a listed company is doing a rights issue, then the issue size is 50 crores or more. Only then the ICDR will apply. Listed issuer, right issue, only 50 crore or more, then only ICDR will apply. But now this 50 crore limit they took out. So for all the right issue by a listed issuer, the ICDR will apply. So that is the thing. 5. Eligibility to make IPO. So when you are having outstanding convertible securities and all, you should first convert it. Then only you can do the IPO. But now we are having the exemption. Generally, what is the rule? When you are having outstanding convertible securities or right entitlement, right issue you are having, you are not eligible to file the offer document. But now we are having the exception. In this case, the issuer will be eligible. Use of outstanding employee stock option plan. When you are having this, you will still be eligible. Then stock appreciation right held by past or present employees. Now, what is the condition is that when you are having this in your company, you should convert it into shares before filing the red herring prospectus or the prospectus. You should convert it before filing the prospectus. At the time of filing the offer document, no need to do anything. But when you are filing the red herring prospectus or prospectus, you should convert it into shares. Then disclosure. Whatever the number of equity shares that are resulting, that you have to disclose it in the red herring prospectus or the prospectus. How much shares it came when you are converting this stock appreciation rights, that you have to mention it in that document. Fully paid securities. When the securities are convertible on or before the date of filing prospectus, then okay. Earlier, at the time of filing the offer document itself, you should not have anything outstanding. But here they have given that for stock appreciation right and fully paid security, before filing the prospectus, if you convert it into shares, then that is okay. Next, Regulation 14, minimum promoter contribution in case of IPO. So normally, what is the minimum promoter contribution? 20% of post-issue capital. Now, if they cannot meet the 20% requirement alone, the promoter should have 20% of shares in the post-issue capital. So that is the requirement. If they cannot meet it separately by themselves, they can invite others also to contribute for that 20% requirement. Shortfall up to 10% of post-issue capital can be met by alternative investment fund, foreign venture capitalist, and then scheduled commercial bank, public financial institution, insurance companies which are registered with IRDA. So these people can come and contribute. They can purchase some shares, and that will also be considered in the 20% minimum requirement for the promoter. So here they have added two more people who can come and purchase the shares, which will also be considered for the minimum promoter contribution. So the first one is public shareholders, non-individual holding 5% or more. So non-individual public shareholders who are having 5% or more shares, post-issue capital, they can purchase more post-issue capital, and then they can contribute to the requirement. Next, any promoter group entity other than the promoter himself. In the promoter group, some entity they can come and purchase the shares. That will also be considered in the promoter contribution only. Next, if there is no promoter, then the 20% requirement does not apply. Okay. The next one is public announcement and advertisement. When you are doing the public announcement, you have to host the draft offer document. What is the meaning of hosting the draft offer document? You have to make it available. The draft offer document, make it public. Allow the public to access it. You should post that document in SEBI website, stock exchange website, and then the lead manager website. In those websites, the document should be available. The public should be accessing it. So, from the date of public announcement, for at least 21 days, that offer document should be remaining public. Then only you can go to the next step. Next, advertisement. Pre-issue advertisement and price band advertisement. This all you should do in the same newspaper in which you are giving the public announcement under this regulation 124. Under regulation 124 also, I have to give the public announcement. So the pre-issue and price band advertisement, that also should be in the same newspaper. Okay. Next one is reporting requirement. When there is any promoter transaction, any transaction between the promoter and promoter group, from the date of filing offer document, draft of the offer document till the date of closure must be reported to the stock exchange within 24 hours. So, from the date of filing draft of the document till the date of closure, when you are doing any transaction, promoter is doing any transaction with the promoter group, then you should report the transaction to the stock exchange within 24 hours. Next one is pre-IPO placement, a private sale of shares just before the IPO. When you are doing a private sale of shares just before the IPO, that you have also disclosed in the draft offer document, that when you are doing the transaction, within 24 hours of the transaction, you have to report it to the stock exchange. Already in the draft offer document, you have mentioned that transaction. We are going to do the transaction. After doing the transaction also, within 24 hours, report it to the stock exchange. Next, they have deleted one point. The requirement of lead manager to submit post-issue report and due diligence certificate within 7 days has been deleted in the latest updates. So, lead manager has to submit the post-issue report and due diligence certificate within 7 days. That requirement was there previously, but now it is deleted. So, that point also I have given here. Next, that's all about the ICDR regulations amendment. If you have already studied the regulations only, you will be able to connect with this. So, if I start to explain each and every point for that regulation, it will take a lot of time. So, I am just giving an overview. The next point is substantial acquisition of shares and takeover regulations. Here we can see what all the amendments we are having. Enterprise value. In definitions, the definition of enterprise value, the definition is now market capital plus debt plus minority interest along with the preferential you have to add it, then reduce the cash and cash equivalent. This will be the enterprise value. This is the definition for enterprise value under the SEBI regulations. Next, frequently traded shares. What is the criteria for a share to be frequently traded? When the share will be considered as frequently traded? When the trading turnover during the 12 calendar months preceding the month of public announcement is 10% of the total number of listed shares. So, public announcement you will be doing, open offer you will be giving, public announcement you will be doing for that open offer. Then, during that open offer, public announcement, the public announcement, for example, you are doing in 1 month, the preceding 12 months. So, public announcement, for example, you are doing in October, the previous months, September, then in August, then July, all these months you have to take. Excluding this October, previous 12 months you have to take. And in those 12 months, what is the trading turnover of the share? Trading turnover means how much shares have been sold. How much shares sold during those 12 months that you have to take. If that is more than 10% of the total number of shares, 10% or more. If that shares is 10% or more, then that will be called as a frequently traded shares. The month in which you are making the public announcement, preceding 12 months, you have to take the trading turnover, and if that is 10% of the total number of listed shares, then the share will be considered as frequently traded. If you are having any bonus or rights issue during the year, you can take the weighted average number of shares. Next, identified date. So, when you are having the open offer and all, there will be an identified date. It is the cutoff date for determining the shareholders who will receive the letter of offer. The open offer should be communicated to the shareholders of the company. So, on which date you have to take the shareholders? On which date you have to take the list of shareholders and give them the open offer? For these shareholders only, we will send the open offer letter. So, when you see on which date we have to take the shareholder list. So, that is the identified date. So, what is the identified date? It should be 10 working days before the start of tendering period. Tendering period means the offer period in which the shareholders can offer their shares to the company which is making the open offer. So, before that offering period, tendering period, 10 working days. Before that will be the identified date. Next, other definitions. Immediate relative, we have the definition, and then tendering period they have given. Next, working day. Any working day of the board will be considered as a working day for the purpose of regulations, substantial acquisition of shares and takeover regulations. So the next thing is insider trading regulations. So that's all about the takeover regulations. Now we can move to the insider trading. Here, the insider trading regulations. What is the meaning of insider? A connected person or a person who is having unpublished price-sensitive information. So, what is the meaning of unpublished price-sensitive information? Here, when you see any non-public information relating to a company or securities, which if you are announcing it publicly, it will materially affect the price. So the price of the share will be affected when you are publicly announcing that particular information. Then that information is called as unpublished price sensitive information. The detailed inclusion they have given here. But till for just an introduction, this is the UPSI, and when you are having UPSI, that information, you will be considered an insider for the purpose of this regulations. So the burden of proof. So when an insider trading allegation is coming, who should prove that they were not trading on the basis of UPSI? So if it is a connected person, so when you are a connected person, the person should prove that he did not have the UPSI at the time of trading. When you are trading, you should not have the UPSI. That is the main intention of this regulations. So when you are trading, you should not have UPSI. When you are a connected person and an insider trading allegation is coming, the connected person should prove that he did not have the UPSI when he was doing the trading. So that burden is on the connected person. Other cases, the board, SEBI should prove that you had the UPSI. You are a normal person, you are not a connected person. Then when an insider trading allegation is coming on you, the SEBI board should prove that you had UPSI when you were doing the trading. Next, connected person. Any person associated with the company in any capacity. When you are in a contract or fiduciary capacity or employment or director officer, in any capacity, when you are working with the company, when you are associated with the company, which provides you access to UPSI, you are in a position that you will be able to access the unpublished price sensitive information of the company. Then you will be a connected person. you are a directly connected person. Then here we are having a list. These people will be called as deemed connected persons. They are not directly connected under this definition, but they are connected to the connected person. So they will be deemed connected person. Relatives of connected person, holding associate subsidiary companies, intermediaries, their employees or directors. Intermediaries means stockbroker. These people and all will handle the information, many information like financial information, everything will be handled by these people. So they will be considered as a deemed connected person. Then investment company, trustee company, asset management company, their employees, their directors, officials of stock exchanges and clearing corporations, all these people will be deemed to be connected persons. Next, we are having two important points here. When you see category D, investment company, trustee company, asset management company, and their employees or directors. So here, any person is a connected person. As per point D above, as per point D, if any person is a connected person, and he is a partner of a firm, the entire firm, its partners and employees are treated as connected person. For example, a person is a director of an investment company. Then this person, director, is also a partner in one firm. Then what will happen? The entire firm, all the partners of the firm, all the partners and then all the employees and all the persons in that firm will be considered to be connected persons. So that's what they have given here. If a person is a connected person because of point D, and such person is a partner of a firm, the entire firm, its partners, employees, everyone will be treated as connected persons. Any person sharing a household or residence with a person mentioned in point D. Any person who is sharing a household or residence under a person who is deemed to be connected under point D. Point D person, 2 points we are having. When point D person you are sharing a household with him, then you will also be considered as a deemed connected person. Next thing is generally available information. Two information we are having. One is generally available information. Second one is unpublished price sensitive information. Generally available information means it is available to the public on a non-discriminatory basis. Everyone knows that. It is published on a stock exchange website, or it is published on the company website, or it is published in the newspapers. Those information will be considered as generally available information. Then unpublished price sensitive information, we already saw what is the basic meaning. The inclusions are financial result, when you're doing merger, demerger, the information relating to that, changes in the managerial personnel, resignation of the auditor, any change in the credit rating of the company. The credit rating will be there for the company for borrowing the loans. If there is any change, that will be an unpublished price sensitive information. If there is a fraud by the company, promoter, KMP, director, subsidiary, or there is an arrest of the KMP, promoter, director, all this will be coming under UPSI. Forensic audit. If any forensic audit is started on the company and the final report of the forensic audit is done, then that will also be UPSI. If winding up application is filed and the application is admitted, then if the application for corporate insolvency resolution process is filed and that is admitted, then if a resolution plan is approved or rejected, this and all will have an impact on the share price. So this will be considered as UPSI. Then outcome of the litigation, if there is any case going on against the company, the outcome of that case, guarantee or surety, non-routine. When the company is giving a guarantee or surety for some borrower, then that is not in the ordinary course of business. Then in that case, it will be considered as a UPSI. Key license for regulatory approval. For example, the company has an important regulatory approval pending, that is granted or that is withdrawn, that is surrendered, that is cancelled by the regulatory authority, or it is suspended, then that will be considered as a UPSI. This will impact the share price because it is directly related to the business of that particular company. Loan borrowed, restructuring or one-time settlement of the loan. When you are borrowing a loan and you are doing restructuring of that loan, you are changing the repayment schedule by communicating with the bankers that you are unable to pay. This shows a weak financial structure of the company. The company is unable to meet the loan repayment. This is a bad thing for the financial health of the company. So that will affect the share price. So that is UPSI. So when you are seeing credit rating, ESG rating will not be considered. Environmental, social, governance rating, that will incorporate all the pollution done by the company, all the corporate governance related matters. That also will be considered when they are giving the ESG rating. So that is not a UPSI. Then if you are doing any change to the change in KMP due to the superannuation or term end, so in that case also it will not come under the UPSI. As per the terms of contract itself, the position is ending. Then in that case, it will not come under UPSI. Next, structured digital database. When you are sharing UPSI to any person, you should maintain it in a database. To whom you are sharing, the name, the nature of UPSI that is shared, name and PAN of the person who shared it, name and PAN of the person who received it. All that should be maintained in a structured digital database. It should be maintained internally. You cannot outsource it to any person. That is, the server should be maintained by the company. It should have adequate internal controls and all. Then, if the UPSI is coming from outside the organization, the company should record it within 2 calendar days. Okay, within 2 calendar days, you have to enter it in that database, structured digital database. So this is the database that you have to maintain. This internally maintaining point and these data that should be recorded, these two are important points. Next, FEMA. When you are doing export of goods, the exporter should declare the full value of the goods or software which you are exporting. But certain items, the value of those will not be included in the full value. What are all those items? Ships, stores, transshipment cargo, goods for military, naval, air force, that and all will not come under the full value. No need to declare the value of those goods. Additionally, they have added these things also: tugs or tugboats, dredgers, vessels used for providing offshore support services. These items, even if you are sending along with the export, no need to add it to the full value. Condition for exemption. This exemption is strictly subject to the re-import into India. You should again bring these things into India. Only then that is applicable. If you are permanently sending these things, then it should be added to the full value. Next, FCRA. In FCRA, when you are receiving the foreign contribution, there is a limit on the administrative expense. So, foreign contribution, why you are getting? To do the social work, to do good for the society. But when you are using all that thing in admin expense, what will come under admin expense? The legal fees, the salary to the accountant, and then all the administrative things will come under admin expense. How much you can spend for this administrative purpose? We are having a limit on that. That is 20%. Cannot spend more than 20% of foreign contribution in one financial year on administrative expense. So still the 20% limit only is there. But when you want to exceed that limit, we need the central government approval. The next thing is, when you are having unspent limit in one financial year, you are having 20% limit. For example, you are getting 100 crore for foreign contribution, 20 crore you can spend in administrative expense. But this year you were able to spend only 15 crore. Now you can carry forward this 5 crore limit that you are having. Total 20 crore allowed, but actually you done only 15 crore. This 5 crore unutilized limit that you are having, you can carry forward to the next year, immediately succeeding financial year. For the 1 year, you can carry forward that particular remaining amount. Next, IBC. Section 12, the time limit for completion of CIRP. So, the resolution professional cannot file for a time extension on his own. The resolution professional must be instructed by the committee of creditors to file the application with adjudicating authority for extending the time limit of CIRP. In the corporate insolvency resolution process, we are having a time limit within which we have to complete that. When you want to extend that, the resolution professional should get an instruction from the committee of creditors. Then only the resolution professional can give an application to the adjudicating authority. Next, continuity of duties. When the application for extension is pending, the resolution professional should do the work normally. He should not stop the work and all. He should continue to discharge the duty even when the application is pending. Next, meeting of committee of creditor. When you are having a committee of creditor, they will be doing the meeting, and in that meeting, who will be present? All the financial creditor will be present. When you are not having the financial creditor, the operational creditor will be present, and then workman representative, those people and all will be present. So they will be present when you are not having the financial creditor. So these people will be there in the meeting. You can keep the directors also, you can keep the promoters also. Those people can attend the meeting, but only these people will have the voting rights. And the committee of creditors also has one power. They can invite some people. They can invite some people to attend the meeting. Just they will attend the meeting as observers. So they will not have any voting right, but they will attend the meeting as observers. The committee of creditors has the power to invite some people. So they have added one more power. The competent authority can be invited. What is the competent authority under the RERA Act? They can invite the competent authority under the RERA Act. The definition for competent authority is given under this section for the RERA Act. They will provide the input on project development matters. They will be invited as an observer by the committee of creditors. Next. Financiers, providers of interim finance to the corporate debtor. When the company is undergoing the resolution process, and during that in-between period, they need some interim finance, some kind of temporary loan they want, then the providers of such loan, they can also be invited to the meetings by the committee without any voting rights. These people, they will be invited to the meeting, but they will not have any voting rights. So that is the meaning of this amendment. So we have covered all the amendments. In a detailed manner we have covered. So that's all about the amendments which are there for CTA law. This is applicable for May 26 and onwards. All the amendments we have covered. So that's all about the amendments.